To our markets panel, Fundstrat Global Advisors Managing Partner Tom Lee and GoodHaven Fund co-founder Larry Pitkowsky are here. Guys, we've just wrapped up the first quarter, and Tom, let me start with you. When I think about what happened, the dollar was supposed to go up, it went down. Interest rates were supposed to go up, they went down. The stock market was supposed to go up, it went up. What stands out for you as you reflect back on the first 3 months of the year?
I think it is a testament to how much animal spirits have improved. Like you see it in the CEO confidence surveys, small business, consumer, and the rotation of flows into the equity markets. I think those have been underpinning the rise in the first quarter.
So was the flows into equities surprising? I mean, you've tracked flows for years and years. Did more money go into equities than you thought?
Yeah, the pace in the first quarter is probably going to end up being the largest since 2009.
Wow. Oh, all right. So that's good news. I guess the big question, though, is it going to continue? I mean, and what is this about? Is this people playing catch-up, do you think, Larry? That they've said to themselves, OK, now it's time for me to get in that many months after the fact?
You know, Trish, at GoodHaven, we are primarily stock pickers, value-oriented folks, but it does appear that people seem to be looking forward to the prospect of potential lower corporate tax rates, which, of course, everything else being equal, will flow to the bottom line, less regulation, and starting to extrapolate that into their thinking on valuation. But we would note that that's from already high valuations, so as valuations get a little bit stretched, we think it's very important to maintain one's discipline going forward.
But it's got to be more than that in some ways, right? Because we've known for some time now that the expectation is for lower corporate taxes, for lower income taxes for individuals, and for there to be less regulation. I mean, that's kind of been built in from the day Donald Trump was elected. If anything, people are now worried that maybe it's not going to happen. They're starting to feel this trepidation as a result of the health care debacle. So what is encouraging them to still get in?
It's a great question, and I think one of the themes that is going to develop over the next few months is there are divergences. Dollar reversing, oil reversing, high yield and equities are not tracking each other anymore, which historically high yield generally leads stocks. But I think if you do it at the company level, you can really see the optimism. Earnings growth is going to be positive year over year in double digits, and so that's positive. And you have to remember, in the last 7 years, households have saved trillions of dollars, and almost none of it went to the stock market. So there is a lot of money that could come into the equity markets.
Earlier this week, our Maria Bartiromo spoke to Federal Reserve Bank of San Francisco President John Williams. He has an aggressive outlook on the Fed rate hikes. Take a listen.
Right now, I think this view that my colleagues have expressed in our various projections that 3 rate hikes overall for this year seems to be about right. I think there's some upside risk to the economy, not risk, but upside potential to the economy. Maybe we'll need to have maybe 4 rate hikes this year, depending on the economic data, depending on how inflation and employment do. I think that will continue in next year as we move more to a normal interest rate. That's kind of what I think.
The funny thing is that if you reflect back a year ago, Trish, that's when we were saying 3 rate hikes are going to absolutely happen. A year ago, right at the end of the first quarter, 2016. So the question is, now that we're starting to lean towards 4 rate hikes, are we actually even going to get 3? And that's the real question in terms of what's happening outside of the world. Larry, what do you think the Fed's going to do this year?
Our assumption on trying to pick stocks is to assume that the macro environment around us really doesn't change and that they be attractive and the thesis makes sense. So it does seem like you're in an environment where we've come off the bottom on 0% rates. And we've been talking for quite some time that we thought 0% rates was not a normal condition. And we've tried to have some investments within the portfolio that would benefit from higher rates, including a Federated, okay, whereby having a big money market business that they've been waiving fees, and all of a sudden, if you get rates off the floor, recapturing those fees could be a benefit. So without predicting something like that, which isn't really our business, we do want to have some things that might benefit from what seems to be a little bit of a change in the trend.
And you know what? Look, if the Fed thinks things are good enough to actually have to raise 4 times instead of 3, I mean, that's got to be a good thing, right? You want the economy to be growing and to be strong enough that they feel like they got to put a little bit of a brake on it.
Thanks, Larry. Thanks, Tom.